we're hearing a lot about the private credit,
Mhm.
specifically right now, and it seems like every day there's a headline around private credit and this $3 trillion industry. It's getting a ton of coverage. So related to some of those companies getting healthy, where is the interplay of private credit with private equity, and why are the GPs recalling capital in some cases, and what are the implications there for the LPs? I know that's a lot of questions, but anyone
Yeah,
want to
let me
jump in there?
let me I'll tackle some of it and leave some of it for Emily. First you have to think about what the private credit market is, right? The private credit market filled a need and a void left by the banks when banks decided that they were no longer going to lend, or frankly, they were regulated out from lending to
Yeah.
certain types of companies, right? And that's a grand result of the great financial crisis. And so you have an entire industry of people that are former bankers that liked private equity returns, but really liked the safety security of protected debt, right? So it's a relatively new industry that is a
Mhm.
retread of a number of different industries that is lending into a variety of situations, very opportunistically lending into private equity, very opportunistically recapitalizing long-standing companies to help them retool. And when you have that much capital flow in, you're going to, even if you don't lower the underwriting standards, lots of things are going to get funded by someone that may not have been fundable in the past. And I think that's what you're seeing. So you're seeing investors, their LPs that were saying, look, I want something that's safe and secure, but I want equity-like returns. And when you mash up all of those different elements and you attempt to solve for the return horizons that they're looking for, you're going to see people invest in deals that are not as, if I use the term bankable, as they were when banks were doing those deals.
Yeah, that totally makes sense. Emily, do you want to add anything to that?
I think the only other thing I would add is, in terms of taking on private credit and some of the headlines that there are right now for the private credit organizations or firms that are public, is that they're starting to see defaults. And so they did take on a little bit riskier investment just because that's why it was regulated.
Right.
And the issue is now how to have the returns on those investments, or having to put more capital in to kind of ride it out. So that's another area, and the defaults are coming in a lot of different forms. I mean, some of it is the disruption in the marketplace in regards to competitive advantage, as well as just operational issues that may not have been seen in due diligence. But a lot of private, credit is associated with some more risky, maybe industrial or real estate capital intensive, uh, endeavors. For
Yeah,
example, like data
can be.
farms and things like that.
Yeah, it can be.
So
So,
maybe not
so
as default ready.
sorry, I didn't mean to talk over you there. So I think this is really interesting from a governance perspective, because if you are a board member of a portfolio company who is either is using private credit, what impact, or if you're in a private credit fund, I should say, what impact is that having on them? Like, it- you know, what are they thinking about, or what should they be thinking about if they are if they're in a if they're in a private credit fund? Just knowing what you just said.
Yeah, I think that it's the for sure the ensuring that the strategy is continuing to be front and center, and if the strategy needs to change in regards to outside factors, either geopolitical or technology associated, just I think it's still the same governance requirements being on the board, looking at all stakeholders, and shareholders in particular. The creditors are our stakeholder, and being able to apply the appropriate judgment and background to the board, right? So it's all the same governance requirements in regards to strategy setting, and so forth, but with the expectation that you're also considering people who might not be at the table.
Yeah.
Yeah, I think the other way to look at it is one of your responsibilities as a director, particularly in a private company, is really understanding and rationalizing the capital structure of your
Hmm.
company, right? And capital structure, a fancy way of talking about what types of capital do you have at work, and what's the
Exactly.
purpose and best use of that capital. This is an environment we've seen a lot of turmoil, and in turmoil, people use cash. And the question is, where'd you get the cash, right?
Yeah.
Did you get the cash from your equity investors? In which case, you may have a lot more flexibility unless there are covenants around how much equity you need to hold. Did you get the cash from a bank and it's a senior preferred note? And in which case, you're definitely going to have, heavy terms and have a lot of scrutiny over how you use that cash. Or did you get it from a private credit firm, which, by its very nature is going to be a little bit more risk tolerant, maybe a little bit more covenant light, as we would say in the finance world. And even then, you've got to be very prudent and judicious about how you use cash. So all of those are considerations. And as a director, it's not merely checking the three financial reports that you're going to be getting. It's really understanding some of those more esoteric lines, what they mean, and what the implication is to the company.
Okay, exactly. I couldn't agree with you more. And I think if we're used to being public company directors and we're used to working with traditional corporate banks, it's a different language
Yeah.
than when you're looking and working with a non-bank lender. And to your point, where the covenants might be different, that where the cash is coming from is different, but you have the same responsibility, to your point, Emily, whether or not you're a director on public or private, it's the same responsibility in terms of governance. So